Hi, this is Khoo here with a market update on the 18th of November. It's a bit late, but I was on vacation, I was in Korea climbing mountains, so I just got back to Singapore, so I thought it's time to do a bit of a market update. Well, so far the US market has been really bullish. You can see from the S&P 500 index, as of the beginning of January 2019, we are up about, let me see, we're up about 24% for the year, right? 24% gain on the S&P, really good. And right now we're sitting, you can see right now at an all-time high, or near the all-time high at about 3120 on the S&P. Now, if you have been following my videos and my reports and my chat groups, you know that this is no surprise. I expected the market to be at all-time highs, to go even higher by the end of the year, right? And this was in my all my early reports. In fact, this was my report on the 1st of October. These are the reports that my students get that have been following me, and you can see over here I explain back on the 1st of October why I was very, very confident the market was going higher, right? It says over here. So there's several reasons why I'm bullish on the markets right now, because the technical uptrend remains intact. Remember, the trend is your friend. As long as the market is on an uptrend, the uptrend continues, the price is going to go up. Probability, right? Many sectors like big tech, healthcare, cyclicals are very undervalued right now, but not so much right now, but it was a few months ago, not so much anymore. Yield on the S&P 500 is above treasury bond yields, and this is an indicator that stocks are cheap relative to bonds, which means I expect money to flow from bonds to stocks, driving equity markets higher. And seasonality plays a part, right? US markets tend to be the most bullish on the third and fourth term of the presidential term, right? So this is the third year of the presidential term. Next year is the last of the fourth term of the Trump administration. The last two terms, the last 2 years of the term tend to be very bullish, right? And historically, markets tend to rally 15 to 25% following an inversion of the yield curve, which we had 2 months ago. So all signs pointed to the market going up. So now the market's gone up 20% for the year. I'm not surprised. I expected it. Portfolio-wise, I'm pretty happy that I'm still beating the markets, and that's always my goal for the year. You can see that year to date, right? Well, the last 1 month performance was there. Year to date performance, yeah, I'm up about 41% return for the year. That's my portfolio compared to the S&P. Again, it's up about 23%, right? So almost doubling the S&P 500. Pretty happy with that. Also really happy that many of my students out there taking the courses have been doing really well this year as well. You can see recently posted on my chat groups, we have got people like Oscar, who is from Sweden, right? He says, hello Adam Khoo, buying this course was one of the best decisions I've made in my life. Last year, I didn't have a clue what I was doing in the stock market. I ended 2018 with my portfolio down 17%. Early January, I bought this course, and at the moment, I'm up 43.37% year to date. All right. Just want to say a big thanks to you for the value you've provided in this course. We've got Wally from the US. He said my account is up 14.53% year to date since I bought your VM course. Made a few silly mistakes here. Right. Could have done a lot better, but we all make mistakes when we begin, so it's understandable. For some of you who may know Yuan Yi, who is one of my students who attended my program about 5 years ago, but he's now one of our volunteer coaches. He helps to coach many of our new students, and he's also up about 25.89% return this year. That's his portfolio over there. Okay. We've got many other people like Alan. I'm not sure where Alan's from, but he said this is what may happen when you start to apply the VMI principles. VMI is the value momentum investing principles that I teach. It says it's quite visible from the attached image I used to have no clue what I was doing in the stock market. After I started applying the principles in January, things have literally taken a different direction, thanks to Adam and the valuable input that people share in this group. So he kind of like posted his portfolio. You can see that before attending this course, he was like losing money, right? His equity curve was coming down all the way there. And then once he attended the course, he applied the principles, you can see the equity curve started rebounding over there. So it's not about luck, it's not about anything else, it's about using the right strategy. right? People like this guy Keyshaw, I'm not sure where he's from. He said, I also want to share my story. After taking the course last year, I updated my portfolio, sitting on 32% returns. Thank you. Okay, so really happy to know that my students are doing really well. And I always say that the hallmark of a good teacher is to train people who can be as good or even better than you. Because I know a lot of people out there who are great investors and great traders, but they can't teach people to be as good as them, and there's no point over there, right? Now you would think that it would be really simple, for anyone to make money in the markets, right? After all, the whole market, the S&P is up 20%. So any idiot should make money, right? Any blind one-legged squirrel should make money. But the reality is, I can tell you, most retail investors out there who don't have these skills and knowledge have not been making any money this year. In fact, many people I know out there have been losing money this year. So how could you lose money in a market that's going up? And the reason is very simple, because they make their decisions based on reading the mainstream news. And by reading the mainstream news, it always causes you to buy high and sell low. It causes you to sell at the worst time and to buy at the worst time. And let me just show you now all the news that people read in the last couple of months causing them to lose money, right? In fact, it's really sad when I get emails from the general public saying, I lost money, I didn't make money, could you help me, right? And I got one recently, not this guy. This guy's Tong An. Tong An's one of our traders as well. He has turned to be a full-time professional trader for the last 3 years after taking this course. And Tong An's from Seattle, Washington, right? And he's up 42% return this year versus the S&P 500, right? And by the way, I'll also be interviewing Tong An during my 3-day webinar called Black Market, which is coming up. I'll be sharing with you how you can get free tickets to the webinar, where I'll be interviewing people like Tong An. I'll be interviewing my other students, getting them to share how they outperform the market every single year. In fact, Tong An has been able to beat the S&P 500 every year for the last 6 years since he started trading, right? Okay, going back to my earlier story about how I get emails from people out there who are not making money, right? And one of them is this guy. I don't know where he's from, but he just sent me an email. He's somewhere out there. He said, "Hi, Adam, my name is Long Lee. I'm interested in your stock market technical analysis," right? And the thing people don't understand is that you can't just learn technical analysis to do well in the markets. You have to learn everything. You have to learn fundamental analysis, technical analysis, portfolio management. You got to combine everything to beat the market. You can't just learn one thing, right? So that's why I told him. And he said, "I saw the news that the market will crash, so I just removed my 401k off the market," right? So 401k is what Americans have, right? It's kind of like their savings, right? And then the market ran up and I missed it, right? Can you now tell me, is it a good time to buy the S&P 500 or to hold, right? So, well, here's my answer to you, right? Right now, if you want to buy the S&P, it's really too high. You can't buy it right now. You should have bought it 3-6 months ago. Right now, you got to wait for it to retrace back and to get in at a lower level. But the trouble is, most people would jump in now and they may get killed as it comes down. So again, let me show you all the news that came out in the last few months and how it screwed up most of the retail investors out there. So 3 months ago, all the news headlines were telling people to sell their stock. You're saying recession is coming, bear market is coming, get off the market, right? So this was on the 22nd of August, again 3 months ago, and this was on CNBC. It says what, recession may already be here. Long-time market bear David Tice warns. Ooh, right? So people read this, they freak out, they sell. They sell on the 26th of August, right? And then on the 1st of October, what does it say? Low profit growth threatens rising debt and possible recession, S&P warns. Now, S&P is warning you that, hey, you know what? You gotta get out, right? 1st of October, right? 7th of October, another guy, Gary Schilling, he said it's time to start shorting the S&P 500. He's asking to go short on the S&P 500, going against the trend. Never short against the trend. Are you nuts? 8th of October, the father of the yield curve. How can you not listen to the father? Right? The father of the yield curve indicator says now is the time to prepare for a recession on the 8th of October. And then finally on the 16th of October, and it says awfully high risk of a global recession in the next 12 to 18 months. Moody's chief economist says. How can you listen to someone who's moody? Of course he's upset. He's always moody, right? Okay. Now, bear in mind, look at when all these news came out. It comes out after the market has dropped. So the trouble is, every time the market goes down, the news will always explain why it went down. It went down because of all these bad things, right? Then when the market goes up, it then explains why it went up. So it always explains after the fact. So if you take a look at the charts, this is what you're going to see on the charts, right? So now you know that from my courses, as long as it's an uptrend, we stay long. As long as the moving averages are in sequence, right? Your 50 moving average above the 150, above the 200 is an uptrend. And you always want to buy when the price retraces to the moving average, right? So it retraces, you want to buy here, right? Retraces by there, retraces by there. So you always want to buy the support level. So whenever it bounces off the moving average support, these are times you want to add to your positions, right? You add, and then when it goes up there, you could take some profit if you want to, right? But take a look at when these articles came out, okay? On the 22nd of August, that first article I showed you, where they told you the recession may be here, it came out here. After the market went down, they tell you to sell over there. And that's the worst time to sell. That's when you should be buying, not selling, okay? And then on the 1st of October, it says, possible recession over here. Again, market drops, they tell you to sell. What kind of idiots, right? And 7 October, market drops, they tell you to sell again. Time to short the S&P. So all this news came out to get you to sell at these times when you should be buying and not selling, okay? And sure enough, if you had sold at these levels, you would have missed on this rally over here. So right now we're up here. You know what's the big joke? Now that the market has gone up, guess what the news is saying? Now the news is telling you to buy. Here, 28th of October. Now they say, chart analysts say new record gives investors the green light to jump back into the bull market. Now they're telling you to jump back in after the market has gone up. Yeah, real smart, right? The stock market keeps setting new highs in a rally no one saw coming. Yeah, right. I saw it coming. All my students saw it coming. It was in my reports every month, and I'll show it to you in a short while. But they say that no one sees it coming. No, only you did not see it coming, right? So take a look at the charts right now. So now that the market has gone up, right, they're telling you to jump back into the market right now, right? Over here, they're saying, hey, get back into the market. Now, I'm not saying that the market is going to come down immediately, right? But what I'm saying is that as a smart investor, remember, you never want to buy when the price is too far from the moving average. You never want to buy the highs. You always want to buy low and sell high. So you always want to buy when the price is near the moving averages. So right now, it's gone away from the moving average. I would not want to add more positions right now. In fact, once the price gets a bit too overbought, I'm going to show you in a short while how I determine when the price is too overbought. Once it gets too overbought, I expect it to come back down again. Because again, what goes up has to come down. It can't go up forever, right? And once I see it's coming down, I could take some profits off the table by selling some stock. Or what I generally do is I sell covered calls, right? And I buy put options to make some money as it comes back down again. And where again, I start to pick up shares at a cheap price. So always remember that the market moves in wave patterns. And I've mentioned this many times before. It's kind of like the breathing pattern, right? So on a clear uptrend, a bull market, which we're in right now, you have got what we call the impulsive wave. Breathe out, breathe in, breathe out, breathe in, and the trend continues, right? So again, to make money, you want to buy when? You always want to buy when it's breathing in, at the end of the retracement, right? So you want to buy over there, you want to buy over there. And again, how do we know it's the end of the retracement? We take our cue from support levels, like in the moving average, right? So in this case, you can see that the 150, the green line, acts as a strong level of support. So that's why I say those are the times we want to add. But again, by reading the news, they tell you to sell over there, which to me makes no sense, right? So that's where you want to be buying and not selling. And now when the market has gone up, they're telling you to buy to get back into the market may not be the best time because they're telling you to get back in over here. Now you never want to buy after the market has breathed out. Because once it's breathed out, you know what? It's not gonna keep going up forever. It has to come back down again. So we call that retracement back to the mean. Now, the question people would ask me is, okay, Adam, are we right now at the top? Okay, do you think we're at the top and do you think we're coming back down soon? If we are, I'm going to take some profits, sell covered calls by put options. Again, it's very tricky to tell. It's really hard to tell exactly where's the top, but let me share with you now how I do my best to kind of like anticipate it. All right, so currently is the market kind of like overbought, and do we expect it to retrace and come back down anytime soon, right? Now, I did talk a bit about this in my earlier video. If you missed it, you may want to watch it, check it out. It's called How I Identify Turning Points in the Stock Market, and it was posted about a couple of weeks ago. So go watch this video where I talk about more in detail how I use these indicators. So there are a few things I use. First thing is I use a Fibonacci retracement and projection, right? So the first thing is I identify where was the last Fibonacci retracement, and it is here. Okay, so this is your A, that's your B, and that's your C. All right. Now I don't take A, B, C because this made a lower high. It made a lower high, and this was not at a Fibonacci retracement level, so I can't take this as an ABC. So I've got to take this as an ABC. So once I identify the ABC pattern, I use my Fibonacci tool and I go, okay, A, B, C. There you go. All right, so you can see that over here, this was a very nice retracement to the 61.8% Fibonacci level. And 61.8% is the strongest support level in a Fibonacci retracement. So once it has retraced to a Fib level, I then use an extension to see where it's going to go. Okay, so I use Fibonacci extension over here, and I go again A, B, and go back to that same C level, which is over here. Well, it's subjective, right? I could place my C at the 61.8, or I could put it at the low over here, right? So again, depends on how conservative you want to be. So if you want to be more conservative, I could put it over here, right? So if I put it over here, you can see in that case, my 100% projection would be where we are right now, 3120. So this tells me that this could be potentially the end of this current projection, and we're coming down, right? So that is if I move the retracement over there. Now, if I put the retracement somewhere else, like here, okay, so if I do this A, B, and C, right, you could see that we could be looking at the 3146 level, or 3146 level. So again, you can't be precise, but I would say anywhere between 3125 to 3146. That would probably be where I'm looking for it to end up before retracing back down again, right? So it could potentially go up to 3146. So I tell you what, I'm gonna put my level over there, because the market still seems really bullish. We are not even in December yet. In December, the Santa Claus rally, usually December tends to be a very bullish month as well. So I'm going to put a potential target at 3146 and another one at 3125. So that's my range. There we go. So let me get rid of all this so it's not so messy. Okay, there we go. Okay. So in other words, I have another 20 points more to go before we hit our potential top of this projection, right? Now, again, when it comes to making anticipations about turning points, you don't look at one thing. You can't just look at Fibonacci or something. You have to look at confluence between many things. So you want to see confluence between Fibonacci, Bollinger Bands, stochastics, and they must all tell you the same thing. So when I see at least 2 or 3 confluence levels, then I'm pretty confident that that's the point I could start to sell covered calls. I can take profits or buy puts to make some money as it retraces back down temporarily. But again, like I said, having said that, I'm not looking at a change in trend. I'm still bullish. I see a short-term retracement before we go even higher. All right. Now, if I put in the Bollinger Bands, there we go with Bollinger Bands. So you can see that stochastics is already above 80. So stochastics already overbought. The Bollinger Bands are here. So yeah, it pretty much lines up, right? So if the market goes up another 20 points or so, we'll probably hit the upper Bollinger Bands, which means on the Bollinger Bands it's overbought. Stochastic overbought, we've got two overbought levels, but I have to wait for the stochastics to turn back down again from above 80 to below 80 before I start to do some short-term hedging, right? Again, selling covered calls on the S&P or buying protective puts, right? So again, looking at that 20 points up and then a possible retracement back down, but we'll see how it goes, right? Another thing that I actually look at is I look at this thing called the S&P oscillator, right? The S&P oscillator is a pretty useful tool, right? This is the S&P short range oscillator, and you can see that the S&P oscillates from, again, overbought levels to oversold levels. And anytime it is above 5% on the oscillator, it is overbought, below 5% is oversold. So generally, once the oscillator goes below -5, like over here, that's when you want to start buying, right? Buy when it's oversold, ready to bounce back up. But of course, the overall trend must be up, must be an uptrend, right? And once the oscillator goes above 5, like here, like goes over here above 5, that's when it gets overbought, ready to come back down again. And the interesting thing is that from the oscillator, it doesn't seem to be overbought just yet, right? You can see over here, as of Friday, the oscillator is only at 1.6%, right? So it's nowhere near 5%. So based on this oscillator, it's not overbought yet, right? Okay. So I look at many factors, right? And once everything's aligned, I know it's overbought, that's when I start hedging and I start doing some short-term shorts. Now, another thing which I look at is the VIX, all right? VIX is VIX. So what is the VIX? The VIX is the Market Volatility Index. Now, the VIX is also known as the fear indicator. It measures how much fear there is in the markets, okay? And you can see the VIX pretty much moves in a range, yeah? So whenever the market is going up, people are not fearful anymore. They're like, yeah, it's doing well, right? And whenever that happens, the VIX goes down. The VIX goes down, right? So right now the market is going up. The VIX, you can see, is at its historical low, at least for the last 12 months. Whenever the market goes down and people are scared, people are fearful, the VIX goes up. So this is when it's fearful, right? So the VIX moves opposite of the S&P 500, basically. When the market goes up, the VIX goes down. Market goes down, VIX goes up. You know what I'm saying? Right? So now that the market is going up, the VIX has gone down to its support level. Now, it's not exactly right at the support, but it's coming to the support. So what does this mean? This means that from the VIX, we can also tell when the market is getting too complacent and we expect fear to come back and to drive the VIX up again and the market down again. Okay? So in other words, right now, the VIX is at 12, okay? And it's not exactly right at the bottom. The bottom would be somewhere about maybe about 11.45, right? 11.45. So we expect, again, market to go up a bit more, VIX to come down to 11.30, 11.45. And then when that happens, you know, we expect it to, market to come down and the VIX to go back up again, right? So could we make some money on the VIX? Yeah, we could, right? So some of you could be thinking, okay, could I buy the VIX now? Could I buy the VIX at $12 right now and then sell the VIX at $21? Could I make some money doing that? Well, you can't buy and sell the VIX because the VIX is an indicator. You can't buy the indicator, right? But you could trade options on the VIX, and that's what I do, right? So I buy options, I buy call options on the VIX as a way to hedge my long investments in the stock market. So what that means is when the stock market goes down, I make money on my call options on the VIX. So I'm going to show you how I can set it up so that I got a really great risk to return ratio right now. Okay, so basically, I expect the VIX to go down a bit more maybe, and then soon it's going to go up. So what I'm going to do is I'm going to buy a call option on the VIX, slightly out of the money. So I'm going to buy a call at a strike price of 13. All right. And at the same time, I'm going to sell a call. I'm going to sell the call at a strike price of 21. So we call this a vertical call spread. So I'm going to buy a call at 13 and sell the call at 21. So when I do that, let me show you what happens. It's pretty cool. So I'm going to go to trade over here. And I'm going to choose the 30-day expiry, or the closest be 29 days expiry. This expires on the 18th of December. I'm going to choose the 13 call, which is a bit out of the money. Right click, buy vertical spread. Okay, there we go. So I'm going to buy the 13 strike call and sell the 21. There we go. So how much would it cost me to get into this trade? It will cost me $2. Okay, so each contract is 100 shares. So 2 times 100 is $200. So the cost of the contract is $200, and that's my maximum risk. The most I can lose if I'm wrong, that means the VIX doesn't go back up, I lose $200. All right. Now, how much will I make if I'm right? If it goes back up, right, you can see that my potential profit would be my maximum profit would be $600. Okay, my maximum loss would be $200, and that's a pretty good deal because I'm risking $200 to make $600. We call this a risk to return ratio of risking 1 to make 3. And that's a great trade. That's a great trade, right? Very good trade. That's why I'm now taking this trade. And you can actually look at the risk to return graph that looks something like that. Analyze the trade. Okay, so it looks something like that. Okay, if you're not familiar with reading this chart, on the y-axis over here, there's a 0 line. Anything above is profit. All right, you're making money. If it goes below, you're losing money. Okay, so you can see that this green line over here, this is the profit and loss at expiration, when it expires in 29 days. So currently the VIX is at 1205, right? This is where we are right now, the current price of the VIX. So I expect that the market's going to come down in 30 days. When it comes down, the VIX is going to go up to, maybe 21, which is the previous resistance. If it goes to 21, I will make, you can see, $600. That's my maximum profit. But of course, if it doesn't go up and it goes down, which is unlikely, but it could go down, you can see my maximum loss is I lose $200. Okay, so I risk 200 to make $600. Now, in reality, if I'm wrong, will I lose $200? No, I won't, right? Because I never allow myself to lose everything. Okay, the moment it doesn't go my way, it goes the opposite direction, I would normally cut loss at 50% of the maximum loss, which means the most I will lose is $100, but the most I'll make is $600. So I'm risking $1 to make $6. That's a great trade. So in trading, I can't be right all the time. In fact, I'm only right maybe half the time or slightly more than half the time. But when I'm right, I make a lot of money. When I lose, I lose less money. And that's how I generate consistent profits in my trading and my investment portfolio. All right. So you learn a lot more about this in our options programs, as well as my stock trading programs and my investment programs. Now, finally, if you have not already heard, I'll be hosting for the very first time a 3-day non-stop webinar, all right, from 26th to the 28th of November, and I codename it Black Market. Not just because it's near Black Friday, but because I'm going to review together with my fellow traders and students our deepest, darkest trading tips and secrets. At the same time, we'll be, putting our courses, our options, forex, and stock trading, investing courses at huge Black Friday discounts that you will never see any time throughout the rest of the year. So this is one event that you got to attend, right? If you like to grab your tickets, now this normally retails at 197 US dollars, but for you guys, my YouTube video viewers and subscribers, just look at the description in the video below, click on the link below in the description of the video. That's a registration link where you can grab free tickets. We're giving up to 5,000 free tickets to this black market event. Again, from the 26th to 28th November 2019, it'll be running from 8 p.m. to 2 a.m. Pacific Standard Time daily. So I look forward to seeing you there. This is Khoo. May the markets be with you. Join me on Black Market. We're going to learn how to make a killing in the markets, because if you don't kill, you're going to get killed, right? See you then.